Welcome, everyone. This is episode 3 of the special Capital Markets mini-series sponsored by Optimal Blue. Today, my guest is Jim Glennon, Vice President of Hedging and Trading Client Services at Optimal Blue, to talk about trading in the mortgage market and market dynamics. Jim, welcome to HousingWire Daily.
Great to be here. Thanks so much for having me.
Yeah, I'm really happy to have you on and very interested in this topic. So let's just jump right into sort of understanding trading in the mortgage market, because when most people hear trading and market in the same sentence, they're probably thinking trading stocks in the stock market, right? Or something to that effect. So how does trading in the mortgage market work?
Yeah, it is quite a bit different, right? We're trading to neutralize a position or to maximize our revenue on the loans that we're selling into the secondary market. We're not trying to extract alpha or extra gains. Like, we're not taking a position in the market to put ourselves at risk and try to make money. So I have an analogy that I've used before, which is like airlines, right? If you go back to 2007, 2008, we had that was during the great financial crisis, but oil prices exploded, right? And a lot of airlines got killed by that dynamic in the market. But Southwest Airlines, very specifically, they were in the practice of hedging oil futures to hedge for those seats that they were selling on airplanes, right? So airlines are always selling tickets 6, 9, 12 months in advance, but they have no idea where fuel prices are going to be. And most of the airlines were taking that chance, right? Taking that risk. Whereas Southwest Airlines was using oil futures to hedge that risk. So they had hedges out there perpetually as they were selling tickets to you and I. In the future, they were hedging that risk and knowing that no matter what happened with oil prices, that they were going to make the margin that they had built in on that first day. So when prices did go up, they didn't have to worry about the fact they were losing money on the tickets that they sold because they were making money on the hedges that they sold against the market, against those oil prices. So I think that's a good analogy for hedging mortgages, because it's a very similar market dynamic.
No, that's very interesting. And of course, we know, most people, if they understand mortgages at all, it's almost always, the buying of the mortgage themselves, not the selling into the secondary market. So they're usually thinking about the primary mortgage market, but they don't even think about there's this whole secondary that makes the primary possible. Without that, nothing happens. So let's talk, how does a PPE like Optimal Blue facilitate trading for lenders?
So, a good pricing engine and a good pricing strategy is where the continuum begins, right? Whether you're working with a borrower you've worked with before, or you're working with a borrower that you've brought in through a lead or from another bank, that's essentially where you're establishing the buy transaction for your investment, right? So you're trying to set a price to the market, to the LO, to the broker, to the borrower, that's in a kind of a perfect spot where you know that you're going to be competitive, but you're not overly competitive, right? You're making the margin that you need to make on that loan. So that pricing engine allows you to fine tune that price day to day. And it also allows you hopefully to get at some of the data that exists in that pricing engine from other lenders so that you can consistently set that price exactly where it needs to be, right? You need that data. What are your competitors doing so that you're able to set that price in the right spot? So PPE allows you to deliberately manage that price while building in that margin that you know you need to make to keep your business running, but also while not sticking out, right? Not being the best possible price in the market by 50 basis points, because you don't need to be in that arena or in that over-competitive spot.
So let's talk about, why is trading important for maintaining liquidity and managing interest rate risk, right? Is it similar to the way that a bank manages its cash flow, for instance?
The universe of trading in mortgages right now is huge, a lot bigger than it's ever been. And, that piece of your business is imperative for managing interest rate risk at first, right? So loan comes in through your pricing engine, then you're managing risk against the market. So back to the Southwest Airlines analogy. So you have to have good diversity, right? That's the liquidity. You want to have a ton of broker dealers that you work with, because you're going to be trading what's called MBS or TBAs to hedge that position. And then you're going to want a ton of investors as well to buy those loans at the end of the process. you're going to auction those loans off to try to maximize the revenue that you're bringing in from all those loans that you're selling. So it's important to have that diversity, important to have a large stable of dealers and investors. And then, like, cash flow wise, I think hedging definitely goes hand in hand with cash flow management, because you have these two different instruments, or these two different dynamics going on at once. You've got these hedges, right? Back to maybe they're oil future hedges. In this case, they're TBAs hedging mortgages. And then you have these loans that you're going to be selling, or these plane tickets that you're going to be selling to people. And those transactions are going to happen at different times, right? You're going to settle these hedges at a different time than you're going to sell your loans. So a lot of what goes into trading and hedging and analytics is how do I time up the cash that's coming in and the cash that's going out, so I don't put myself in a position where I have a major cash deficiency in any given month. So there's all kinds of strategies and nuances that go into that trading strategy.
I think that feeds in perfectly to my next question, which is, how does all this trading impact a lender's operational efficiency and market responsiveness?
Yeah. So with that diversity that we talked about a second ago, it's going to give you the ability to implement a strategy that's actually going to make your operation simpler, which probably sounds counterintuitive, right? I'm going to bring in a ton more buyers, but I'm somehow going to make my operation more simple. But the reason being that you're then creating a more homogeneous or a more generic product that more people are going to be willing to buy. So you don't need your loan officers and your processors and your underwriters and your whole back office to understand the guidelines of 5 investors, 10 investors, even 30 investors. They're really going to get to the point where you just need your infrastructure to understand your set of guidelines as a mortgage bank. So that simplifies that piece, right? Just the manufacturing piece of a loan. And then on your capital markets side, if you are hedging your loans and you're not earmarking them for a specific investor at any point in the process till the very end, you're able to then establish your own lock desk rules, right? Whether it's lock extensions or renegotiations or float downs, you're able to build your own products, but also your own policies, so that your loan officers also don't have to understand 18 different investors' policies when it comes to those different things that they might need to do, like a lock extension.
That makes so much sense. Let's talk a little bit about market dynamics, right? How do market dynamics influence trading decisions?
Sure. I mean, the core philosophy is neutrality, right? We're always trying to be neutral to the market. Shouldn't matter whether the market's up, the market's down, whether you're hedging with, if you're delivering best efforts or you're hedging with TBAs, your position's protected. But there's tons of nuances that go into that. And these are the market dynamics I think you're asking about. Month to month, there can be, what's called a bid offer spread and other spreads in the market that need to be watched. Sometimes, like today, we had non-farm payrolls come out this morning, and there's going to be certain days where it's going to be a little bit too volatile, where we don't feel like it's a good day to trade loans, for instance, because the loan sale process can take a little bit of time during the day. So there's going to be nuances that just come from volatility that we're going to want to watch out for as well. Otherwise, I think generally just having good, timely data and good, timely market info is also super important. And that's where your hedge advisor can come in, where some of, HousingWire and other influences in the market could come into play, bringing people that market intel that they need to either know what just happened or know what could be happening in the future, what to watch out for.
Well, let's talk specifically about how Optimal Blue helps lenders make those trading decisions.
Sure. I mean, we sit at the nexus of a ton of transactions every single day, right? So we see what's going on in the market. We see who's buying what. We see best practices. We see worst practices. And in the middle of it, we have this UI, right? That we're in the UI, clients are in the UI, gives them a real time view of what their position looks like, what it looks like in all types of different possible market conditions. So between our systems and our expertise on the desk, we advise our clients based on everything that we see in the current paradigm, and kind of disseminate that information down to our client base. And then on top of that, we do a lot of a lot of publications, a lot of productions in the market as well. We do a ton of webinars. We're doing a podcast right now, but we do a ton of our own podcasts. We write blogs, we write papers about these things. We try to make the best use of that market intel that we gather and that we kind of absorb by osmosis throughout the days, weeks, and months to get the best pieces of that out to our clients. So yeah, in 50% of cases, we're actually making decisions for clients because we do manage a lot of client accounts. But for the other 50%, we're spending a lot of time communicating with them in various ways to help them make the right decisions.
What tends to be the biggest markers to influence those trading decisions?
There's a lot to that. I think it's, volatility is a big one that we watch out for. Market spreads that we talked about earlier. There's a lot that goes on with market spreads. Economic releases are becoming, even in the last month or so, more and more influential in a lot of the decisions that we're making. And changes in your business are another big marker. That's the kind of thing that's the kind of information we're trying to gather from clients in a lot of cases, which is what has changed in your business. Have you brought on a new group of originators? Have you lost a group of originators? Have you brought on a new lead source that's going to make the makeup of your pipeline look a little bit different? Those are the kind of things that we need to know about to make good decisions. But a lot of those market-based influences are the things that we're all watching as an industry.
Especially right now, right? This is a pretty interesting market.
Yeah, we actually we do a webinar every month that started back at the beginning of the pandemic for good reason, right? It was because of the volatility, the massive volatility we saw in March of 2020. And it had, the viewership had dropped off a little bit, still well enough viewers for us to continue doing it. But it over this past year, it was kind of stable. And we hypothesized that it was because there wasn't much going on in the market for the last year until July and August of this year, where we saw a 45% increase on our webinar that we did last week. So I think that validated our hypothesis that folks are going to gather and folks are going to listen more, and more folks are going to take that time to listen to podcasts, to listen to webinars, to have more engagement when they're a little bit more in tune with what's going on in the market. They're hoping to get, some commiseration or some collaboration with others to know that they're not missing anything and that they're seeing the same things in the market that their competitors and their peers are. So it also validated our ambitions to do more of this going forward, right? To continue to get our content out there and continue to get more people engaged, because I think it's very possible or even likely that there's a lot more to come there in terms of just the market rotation, the market shift right now. So that's, we all need to be a lot more in tune now, I think, with what's going on in the mortgage market and just in interest rate markets in general, and probably equities as well. There's just a lot to think about going into the fourth quarter.
I couldn't agree with you more. Jim, thanks so much for sitting down with me today and talking through some of this. Really appreciate it.
Same. No, thank you so much. This has been a really good time. I appreciate it.